Hey guys, Michael here. So today I'm going to be reacting on some videos that I've seen online. Some are a little misleading, some have some grains of truth, but I wanted to provide some perspective from an actual insurance agent. So let's get into it. Let's see here, the first video.
Now you decide you're going to look for a different insurance company. Here's what you should look for. When you're searching for car insurance, the two most important types of coverages are liability and uninsured or underinsured motorist coverage.
So yeah, definitely true. Liability, that's kind of what's required in every single state in the United States. It's what protects you from lawsuits and it's what pays when you get in an accident. The uninsured motorist is what actually takes care of you. So if someone does not have insurance or not enough insurance, your actual insurance policy pays you. And it's usually at the same limits that you use to take care of everyone else through your liability. Sometimes it can be lower.
Liability coverage is when you hit someone else, how much money you're protected with. So if you cause someone $1 million of injuries, but you only have a $100,000 insurance policy, that person can only get $100,000 from your insurance, and then you may owe $900,000.
That is really true. So yeah, if you only have $100,000 in your policy, that's all that will pay out on a per person basis. If you ever taken a look at a policy or your own policy, sometimes you'll see something called like a split limit, like 100/300. Those are really common coverages, which means 100,000 per person, 300,000 per accident. What can happen is exactly what he's saying about you may owe 900,000 if you do get sued for $1 million. Even if you don't have any asset, they can definitely go after and garnish your wages and future wages until that is paid off.
My gentle recommendation is to get as much liability insurance as you are worth. So take your net worth and get that much liability insurance.
Okay, I'm going to have to disagree there. So to get as much liability insurance that you're worth, I mean, yes, you do for the most part, but at the same time, you don't need to be a millionaire to be sued like one. A lot of people out there are driving around with state minimum insurance, and if you were to get in an accident and seriously hurt somebody, I mean, the state minimum in most states is $25,000 per person, and those limits have been around for, I want to say, the 70s. So you would get sued, and you would be out who knows how much in damages. So I would always say, carry as much coverage as you can afford. But again, you don't have to be a millionaire to be sued like one. Just make sure you have adequate amount of coverage, just not state minimums.
The more important coverage is UM, underinsured motorist coverage, sometimes called UIM. That is coverage that protects yourself if someone on the road hits you and doesn't have any insurance or doesn't have enough insurance. So if you're protecting other drivers out on the road for $500,000, but you only have $50,000 of uninsured motorist coverage, that means you're protecting other people 10 times as much as you're protecting yourself.
So yeah, like I said earlier, you can have $500,000 liability, and depending on your insurance agent, or if you purchased it direct through an insurance carrier, to keep the premiums low, what they will do is that they will sell you a, let's say, $100,000 policy, and then just give you $50,000 or maybe just $25,000 in coverage, which is not a lot. And you're like, man, I get plenty of coverage, and yeah, that's pretty much it. You think you got plenty of coverage, and in reality, you don't have any coverage for yourself. So yeah, that is very true.
Say you should get as much coverage as you can get, and it should always match your liability coverage.
Yes, definitely. Definitely true. Get more liability and get it to match, get the to match your liability. Because it's actually really cheap coverage, especially uninsured motorist property damage, which is a separate coverage. That's for our second video. All right, second video, let's take a look. So Scotty Kilmer, I love Scotty Kilmer, so let's just see what he says about insurance. I'm sure it's not anything great, but we'll see.
And I'm going to tell you why you might not want to buy full coverage insurance for your car. For full coverage on your car, the average American pays over $1,700 a year.
Now, I don't know where he got that statistic from. Well, let's see what he says.
Liability insurance costs 67% less.
I'm going to have to disagree there. I don't know where he's getting that number from, but and a lot of times, I mean, full coverage doesn't have to be super expensive. And what full coverage actually is, it's protection for the car. So if you get in an accident, it's what covers the vehicle for damages. So that's what repairs the vehicle, the full coverage, usually comprehensive and collision. collision being when you hit things, comprehensive being everything else, without getting too much into it. But no, I don't think it's at all that big of a difference.
It's a lot of money. Take the Celica. The book value of this thing is about $1,600. A whole year of full coverage. Now, of course, if you buy a new car with payments or a used car with payments, you have to have full coverage because the people that you're paying them, they want their money even if you wreck the car.
Yeah, so if you purchase a vehicle, the bank is going to require you to carry comp and collision, which is the full coverage. They don't care about the liability. That's something you should really care about. But yes, if you purchase a vehicle and you have an insurance policy and you don't see comp and collision on it and you're making payments, they can put forced placed insurance, which is super expensive. And it's basically comp and collision for the bank. It doesn't provide you any coverage. It's not really something you want. So make sure you take a look at your policy and make sure you have comp and collision if you're making payments.
If you have the option, especially with lower priced used cars, you're throwing your money away buying full coverage.
I mean, yes and no. I mean, if the car's like worth $1,000 and full coverage, I mean, again, because it's also an older vehicle, full coverage is going to be a lot cheaper. It could be maybe $40 a month. $40 a month over a year is only $480. So yeah, I mean, I guess over time it may not be worth it, but it really all depends on your own situation. Because if you don't have $1,000 or $2,000 or $3,000 to buy a new vehicle, getting a payout of $2,000-$3,000 and you're paying $20-$40 a month for full coverage, it might be worth it. It just depends on your situation. All right. So the third video here is kind of a millionaire influencer. Let's see what he's got to say.
You'll never get rich in your 20s unless you do these 5 things to get cheaper car insurance. First, don't park your car on the street or in your garage. Your driveway is always the cheapest option. Second.
Okay, that must be a British thing because we don't rate whether it's in your driveway or your garage here in the States. I've never heard of that before.
Add one of your parents to the policy. If they have a good driving history, this can half the price. Third.
Okay, yes, adding your parents or being under your parents' insurance policy can greatly reduce the price. In terms of 50%, I'm not sure about that. I mean, it varies. Every person is going to be a little bit different. But if you don't live with your parents and you add your parent onto the policy, that's generally a no-no in insurance. So you don't want to do that because all the drivers have to reside in the same address in order for the policy to be viable. So if you live somewhere else and your parent is on the policy, you get in an accident, everybody's going to be affected and your insurance carrier could drop you or not pay out on the claim.
Play around with your job title. A student might be cheaper than unemployed. Fourth, don't...
I mean, yeah, but at the same time, you don't want to lie. Like if you're unemployed or you're in between jobs and you're trying to shop around your insurance, you don't want to say you're a student if you're not a student. What can happen is that if they find out, they can basically backdate that discount, remove it, and then charge you that premium. So it's not something you want to do. You want to kind of tell the truth, but yeah, you don't want to, I mean, that's basically insurance fraud. You don't want to do that.
Don't buy add-ons like breakdown coverage. You can buy them cheaper elsewhere. Fifth, make sure to pay in...
Breakdown coverage. Some carriers do cover that. Maybe it is or is not cheaper somewhere else. It's not super common, and warranties are typically, I mean, they are pretty pricey sometimes. So I guess it just depends. You can weigh your options at the dealer if you buy a new vehicle. But if you have a used vehicle and that coverage is available, I would definitely take it because it's not super expensive either.
Full, so you don't have to pay any interest.
Yeah, paying in full is definitely cheaper. Not paying any interest, I mean, we don't call it interest. It's just a bigger discount when you pay in full. So there's not any interest involved, but I mean, I guess that's one way to look at it. Let's see this fourth video about life insurance. Okay, let's see what he's got to say.
When the questions ask about life insurance, how to get even with the life insurance company, you know my statement always, don't cancel your policy. Because the insurance company bank on eventually you canceling your policy. And when you do...
That is so true. That is so true. Do not cancel your insurance policy. Oh, I'm sure a lot of people probably even wonder, how do life insurance companies make money? Well, it's because they collect premiums and they don't pay out on claims because people cancel the policy before they die. So, I mean, yeah, that's super true.
Dude, that premium goes to who? The insurance company. So, but if you keep your policy and you eventually die, they have to pay out. So if you want to get even with the insurance company, buy your policy, never cancel. That is the wisest thing you can do, because what happens with insurance companies is you buy an insurance policy, a 2008 crisis happens, a COVID happens. What's the first thing people cancel? Insurance policy. What they don't realize, the insurance policy you got it when you were 33 years old, healthy. But a crisis happened and now you canceled it. Say you were paying $100 a month. I'm just using basic math. Now you're 43 years old. Okay, you got a wife and 3 kids and you're like, I got to go out there and get an insurance policy. Now you got to pay 200, 300, 400, whatever the number is going to be.
Yeah, super true. You don't want to cancel your insurance policy, and then when you're in a better financial spot, try to get insurance again. Because yes, it is going to be more expensive. It's going to be based off your current age, which if you're older, you will be older. You'll be older, and it's going to be more expensive. You may be less healthy because as we age, we tend to get less healthy, not more healthy.
Depending on based on your health. So we need more policies that say, look, let's incentivize people that don't use health insurance. Let's give credit to people that take care of their health.
That's actually pretty cool. That's a good cool concept. In some other countries, they kind of do something like that where they do provide some sort of incentive. Fortunately, it does not exist here in the States, but that would be really cool. So this next video, it's about homeowners insurance. That's all right. Tips for getting home insurance. All right, let's see what he's got to say.
Here's insider tips for insurance for your house. There's different levels. First of all,
okay, insider tips. I don't know about that. I mean, I would be maybe the closest thing to an insider.
there's something that's known as ACV, actual cash value. Never get ACV because what it does is it takes in depreciation. For example, if
yes, true. Don't get ACV. You always want to get replacement cost. But to be honest, nobody offers ACV. Everybody's going to offer replacement cost, so it's not common. It's very, very rare to get offered ACV.
If your house burned down and they said, man, your drywall was 30 years old and it only had a life of 40 years, they're only going to pay you 25% of the value. The next one,
I mean, it's probably going to be worse than that, actually, because it's going to be considered underinsured. And when you underinsure a home, there's some penalties and you'll get less.
is code upgrades. You want that. You get this replacement cost and code upgrades because if your house burned down and they said, gee, it had old electrical, this code upgrade will take you up to the top level.
So, I mean, I don't know about top level, but it will bring it up to date. If you take a look at your homeowner's policy, it's called building ordinance, and it's typically 10%. So if you have $500,000 home, building ordinance will be $50,000. That's what's going to help bring everything up to code. So we're talking about electric, plumbing, utilities, things like that. It's just an extra 50 grand to help bring everything up to code. All right. And the next video, auto insurance, why you should shop your auto insurance. I already disagree here. Let's see what he's got to say.
Several of the big auto insurers have been losing a tremendous amount of money on writing auto insurance. In fact, State Farm, one of the biggest auto insurers, has had to report that they are losing big money on their average policy holder. And the only big company that's been making money of late, Progressive Insurance. So what happens with the
I don't know where he's getting those numbers from, but I don't think that's accurate.
insurers that are losing a lot of money is when your premiums come up for renewal, they have extra incentive to push the rates way up. Highest we've heard from anybody is a 70% increase at renewal without having had an accident or...
I've seen higher. I mean, it's not because they did anything wrong. It's just, unfortunately, the algorithm just, it was really bad to them and their rates just gone up. Sometimes they had a really, really cheap rate. That's where I typically see it, where they're paying maybe just $50 a month. That is extremely, extremely rare. Maybe 1 out of 1,000 quotes. And they have a renewal and it's $100 a month or it's $80 a month. So it's not a huge difference month to month, like in terms of a $30 more a month, $50 a month. But yes, percentage wise, yeah, that's almost double. But again, very, very rare. Most people are going to be experiencing 10, 15, maybe even 20%. And it's mostly because carriers are losing a lot of money, yes, but it's due to claims, due to the economy, due to everything costing a lot more. And yes, they have to raise the rates because two of the major things insurance pays for is one, medical bills, which we know that's never going to go down, and property. And we know values of parts for auto, building materials for homes, that's always going to go up. Same with labor. So that's the big reason why rates are continuing going up.
Ticket. So be prepared to have to shop around when you get that renewal notice. You may find somebody else would like to insure you at a much lower rate than who you're with right now.
I don't necessarily agree with that. It kind of all depends. So if you're with a carrier for a long time, that's actually going to be really good for you. So you have a credit score and you also have an insurance score. So when you shop around, they're going to look at your insurance score alongside with your credit score. So what that means is that if you stay with a carrier for a long time, that's already going to be beneficial. If you do not have claims, if you have good coverage, so your liability, going back to that earlier, if you have good liability, they're going to see you as a responsible person. If you have a homeowner's policy, so you bundle, they're going to also give you discounts for that. So you want to improve your insurance score. So yes, one day, maybe after being with a carrier for 5, 10, who knows how many years, you want to shop it around. That's going to give you the best likelihood of getting the best rate. But you definitely do not want to shop around every 6 months, every year, because that's going to affect your insurance score. And plus, on top of that, the cheapest carrier is not always the best carrier. You know, customer service, claim service. The whole reason why we buy insurance is that whenever we have a claim, that it is a smooth experience, that we are going to receive a payout. But yeah, so you get what you pay for when it comes to insurance. You don't want to go with a cut rate insurance carrier. So yeah, that's all the videos I have for today. I hope you learned something. If you did, please make sure to like, share, and subscribe. Be sure to follow us on social media. And if you have any further questions, feel free to send us a DM on Instagram. We'll talk to you soon.